With short-term rates having gone up as much as they have recently, it's tempting to abandon longer bonds in favor of purely short duration, money market, cash equivalent type positions. With this slide, I quickly want to go over why that is not necessarily a good idea historically, looking at three different scenarios which we're currently experiencing. So first, to give you some context of the chart that we're looking at, when we're talking about the short cash, we're actually looking at the average money market rate as of, I believe, 6:30 in this scenario. And then when we look at the historical scenarios, we're going back from essentially 1954 and looking at all the times that these different scenarios took place and what was the average outcome during that time period. And what we've seen is that when the Fed funds rate is currently greater inflation, cash has historically generated 5.1% and core bonds 7.5. Now, today, the Fed funds rate is currently between 5 and 5.25, and inflation's at 3. So again, money market rates are paying more than inflation, but in that scenario, historically, longer bonds have tended to outperform in the 12 months following that scenario where Fed funds has exceeded inflation. In a scenario where the Fed stops raising rates, obviously, we don't know if the Fed has stopped raising rates for the final time. However, they have announced that is likely only 1 or 2 more rates for this year. My personal belief is that we're closer to 1 or even 0. But in that scenario, historically, cash has generated about 4.5% returns, and core bonds had generated 11.5 on average. So what happens in this scenario, and the reason that happens, is that when the Fed stops raising rates, longer rates tend to come down, and you see the price of those longer bonds increase in value. So you get outperformance on some of these longer bonds. It's not just about cash flow in this scenario. In scenario 3, short-term rates are higher than long-term rates. Currently, that's certainly the case. The short-term, the 3-month Treasury rates are higher than the 10-year Treasury rates, with short-term rates as of 6:30. We were looking at 5.4% on the 3-month and about 3.8 on the 10-year. As of recording this, the 10 years back above 4%, but still what we're looking at applies here. Historically, cash has generated 4%, core bonds have generated 7.8% over the long term. Essentially, all this is to say that historically, when any of these three scenarios have happened, even though the shortest term rates have looked the most attractive because, again, we had an inverted yield curve. Short rates were higher than long rates. A core bond portfolio, which, and I say core bond portfolio, we're talking about the aggregate bond index. Basically, the entire bond market typically has about a duration around 6 years, has tended to outperform the shorter bonds. And that is because the price of the longer bonds will go up faster as interest rates in the long end start to come down. And again, the problem is if you are loaded up on your cash money market type positions and rates do start to come down, you're now faced with reinvestment risk. Now, the positions look great today, but as interest rates come down, you'll be forced to take that cash and deploy it at less attractive rates long term, and that's never a fun position to put yourself into. So again, as we talk about on the equity side, it's always important to be executing on a plan and not abandoning it one way or another based on short-term fads or trends. So again, if you have questions about this or anything else, just let us know. We'll be happy to talk.